fellow Americans, it's about to get very bad. And I don't say that to be dramatic. I say it because the data that has come out in just the last 2 weeks is unlike anything I have seen since the 2008 financial crisis. Forbes just reported that the personal savings rate in America has collapsed to 2.6%, the lowest since before the pandemic. Real disposable income dropped 0.5% in a single month. The New York Federal Reserve just warned that tariff-related price hikes are not over, and that nearly half of all businesses have more price increases planned for the next 6 months. A Harris poll conducted for The Guardian found that 95% of Americans, 95% believe the country is in the middle of an affordability crisis. And the Committee for a Responsible Federal Budget just published a report titled Break Glass, acknowledging that America is in the worst fiscal position it has ever been in, heading into a potential economic downturn. Worse than before the Great Recession, worse than before COVID. And the question I need to ask you today is this: are you prepared for what is coming next? Because what they just announced, what the data just revealed, what the numbers are screaming at us right now, should have every American paying attention. Americans are now financing their groceries on installment plans, and that should terrify you. Let's start with what I think is the most alarming economic data point of the entire year. Forbes reported on May 29th that 29% of Buy Now, Pay Later users are now using installment loans to buy groceries, not furniture, not electronics, not vacations, groceries, the food they need to feed their families. That number has more than doubled from 2 years ago. And nearly half of all BNPL users, 47%, made at least one late payment in the past year, up from 34% the year before. More than half say they could not make ends meet without these loans. And the Richmond Federal Reserve estimates that total BNPL transaction volume grew roughly 20% per year since 2021, reaching $70 billion in 2025. Let me be clear about what this means. When a significant percentage of the American population cannot afford to buy food without taking out a loan and splitting the payment into 4 installments on their phone, that is not an economy that is doing well. That is an economy in deep structural distress. And the BNPL industry is designed to obscure this distress. Because it doesn't show up on traditional credit reports the same way credit card debt does, it doesn't appear in the official household debt statistics. It's shadow debt. It's debt that the official measurements of the economy were not designed to capture. And the people using it are not irresponsible. They are desperate. They are people whose wages have not kept pace with the cost of food, whose savings have been depleted by 3 years of cumulative price increases, and whose credit cards are already maxed out. The BNPL plan is the last stop on the train before they have nothing left. And 29% of the people on that train are using it to buy groceries. That is a statistic that should be on the front page of every newspaper in the country. It is the single most honest measure of the American economy right now because it tells you what people are actually doing when the bills come due and the money isn't there. And let me put this in historical context because I think it's important that you understand how unprecedented this is. During the Great Depression, Americans couldn't afford food either, but they didn't have installment plans on their phones. They stood in bread lines. The bread line was the visible, public, undeniable evidence of economic failure. The BNPL plan is the invisible, private, deniable version of the same thing. It's a digital breadline. And because it's digital, because it happens on your phone, because nobody can see you do it, it doesn't generate the political urgency that a physical breadline generates. There are no photographs of Americans standing in a BNPL line because the line doesn't exist. The desperation happens in private, on a screen, at 11 p.m. when the kids are in bed and you're trying to figure out how to get through the week. And because the desperation is invisible, the political class feels no pressure to address it. They can point to the GDP number and the unemployment rate and say the economy is growing, and technically they're right, the economy is growing. But it's growing on the backs of people who are borrowing money to buy food, and that is not growth. That is the illusion of growth funded by the depletion of the last remaining resources that American households have left. The savings rate just collapsed to the lowest level since before COVID, and nobody is talking about it. The Bureau of Economic Analysis reported that the personal saving rate fell to 2.6% in April 2026. That is the lowest level since before the pandemic, down from nearly 5% as recently as January. And at the same time, real disposable personal income, your income after taxes and adjusted for inflation, dropped 0.5% in a single month, and yet spending rose 0.5% in nominal terms. Do you see what's happening here? Americans are spending more dollars to buy less stuff, their real income is falling, their savings are being drained, and the gap is being filled by credit, by BNPL loans, by 401k hardship withdrawals, and by simply going without. That is the arithmetic of a squeeze. Forbes put it perfectly. It does not show up as a recession. It does not show up as mass unemployment. It shows up as depleted savings accounts, rising credit card balances, and a generation of Americans who have discovered that you can finance a grocery run across 4 installments on your phone. And a 2.6% savings rate means that the average American household has virtually no buffer against the next emergency. A car repair, a medical bill, a layoff, a broken water heater. Any of these could send a family into a financial spiral because there is nothing in savings to absorb the shock. The Federal Reserve's own survey of household economics found that 37% of Americans could not cover a $400 emergency expense without borrowing or selling something. And that was before the savings rate fell to 2.6%. The cushion is gone, the buffer is gone, and the economy that is supposed to be growing is growing on the backs of consumers who are drawing down savings, maxing out credit cards, and financing their groceries on installment plans. That is not growth. That is consumption funded by the depletion of future capacity. And when the depletion is complete, when there is nothing left to draw down, the spending stops. And when the spending stops, the GDP that was being propped up by the spending collapses. And at that point, the recession that was always there becomes visible to the people who refuse to see it. And I need you to understand the specific mechanics of how a savings depletion this severe affects an economy. Because this is the piece that economists talk about in academic papers but never explain to normal people. When the savings rate drops to 2.6%, it means the average American household is saving approximately $170 per month out of their after-tax income. $170. That is one car repair, one dental visit, 1/2 of 1 month of car insurance. That is the entire margin between stability and crisis for the average American family in the summer of 2026. And this savings depletion does not recover quickly. When savings are drawn down during a period of high inflation and stagnant real wages, rebuilding them requires either income growth that outpaces expenses, which is not happening, or expense reductions that create a surplus, which is not possible when every major expense category is simultaneously increasing. Housing, food, energy, healthcare, insurance, transportation, childcare, every single one is rising faster than wages. So the savings rate will not recover on its own. It will continue to decline until there is nothing left. And at 2.6%, we are very close to nothing left. And when nothing is left, the BNPL loans and the credit cards are the only tools available. And when the credit cards are maxed and the BNPL balances are past due, the final stage begins, default. And default cascades. One person's default becomes their landlord's lost rent, becomes their landlord's mortgage delinquency, becomes the bank's problem, becomes the bank's reduced lending capacity, becomes the small business owner's inability to get a line of credit, becomes that business's layoffs, becomes another person's lost income, becomes another default. The domino effect that starts with depleted savings runs through credit, through lending, through employment, and back to more depleted savings. That is the spiral, and we are inside it right now. The New York Fed just warned that tariff price hikes are not over, and businesses have more increases planned. Last week, Newsweek reported that the New York Federal Reserve published a report warning Americans that tariff-driven price increases are far from finished. According to the New York Fed's latest business surveys, 40% of service sector firms and 70% of manufacturers reported paying tariffs directly over the past year. And here's the critical number. While more than half said they had already passed costs on to consumers, 47% of service firms and 44% of manufacturing firms said they have more tariff-related price increases planned either within or beyond the next 6 months. Let me translate that for you. Nearly half of all American businesses are telling the Federal Reserve that they plan to raise prices further because of tariffs. This isn't speculation. This isn't a warning about what might happen. This is what businesses are planning to do. They told the Fed. And the Fed told us. And nobody seems to be treating this as the emergency it is. The New York Fed economist noted that firms may have deliberately spread their price increases over time to avoid shocking customers. They may have held off on price adjustments because of the uncertainty surrounding the tariff decisions. But now that uncertainty is resolving, and the result is a delayed wave of price increases that is about to hit consumers who are already stretched past breaking. The Tax Foundation calculated that U.S. households are already paying approximately $1,000 more per year as a result of tariffs imposed since early 25, and that is before the second wave of increases that nearly half of all businesses just told the Fed they are planning. The effective tariff rate implied by customs duties went from 2.1% to 11.7%, according to Stanford. That is a five-fold increase in tariff burden, and consumers bear more than 50% of that cost, meaning tariffs are functioning as a hidden tax on every American household. A tax that was never voted on. A tax that does not appear on your W-2. A tax that shows up only in the price at the register, the cost at the pump, and the bill that arrives in the mail. And what makes this particularly infuriating is the timing. The tariff price increases are arriving at the exact moment that the Iran war-related energy prices are cascading through the food chain. So you're getting hit from two directions simultaneously. Energy costs driving up the price of everything that is produced, transported, or stored using energy, which is everything, and tariff costs driving up the price of everything that is imported or that contains imported components, which is also everything. The two inflationary forces are converging on the American consumer at the same time, and neither can be offset by the other. They compound. And the people who designed the tariff policy did not account for the Iran war, and the people managing the Iran war did not account for the tariff impact. Each policy was made in isolation, but the consumer experiences them simultaneously. And the simultaneous impact is what makes this moment different from any previous inflationary period. In the 1970s, inflation was driven primarily by energy. In the 2000s, it was driven by housing. In 2021 and 2022, it was driven by supply chains and monetary expansion. In 2026, it is driven by energy, tariffs, healthcare cost shifts, and embedded inflation expectations, all at the same time. There is no single lever that can address all four drivers simultaneously, and the Fed's only tool, interest rates, can only address demand-side inflation. It cannot fix supply disruptions. It cannot remove tariffs. It cannot undo healthcare cuts. It can only make borrowing more expensive, which punishes the same consumers who are already being punished by every other factor I just listed. 95% of Americans think the country is in an affordability crisis, and the other 5% are lying. A Harris poll conducted for The Guardian found that 95% of Americans believe the United States is in the middle of an affordability crisis driven by the rising cost of groceries, gas, and other expenses. 95%. Think about what that number means. That is not a partisan issue. That is not a demographic divide. That is universal consensus. When 95 out of 100 Americans agree on anything, especially something as politically charged as the state of the economy, it means the reality on the ground has overwhelmed every other narrative. It doesn't matter what the GDP number says. It doesn't matter what the unemployment rate shows. It doesn't matter what the stock market is doing. 95% of the people living inside this economy are telling you it's in crisis, and their lived experience is the only data point that actually matters, because they are the economy. Consumer spending accounts for approximately 2/3 of American GDP. When the consumers tell you they are in crisis, the economy is in crisis by definition, and the University of Michigan Consumer Sentiment Index confirms it. Consumer sentiment sat at record lows throughout the first half of 2026. Joanne Hochschild, the survey's director, noted that consumers appear worried that supply disruptions are unlikely to be resolved quickly, and that increases in gas prices will spread to other prices in the economy. Year-ahead inflation expectations climbed to 4.8%. Long-run expectations rose to 3.9%, a 7-month high. Those expectations matter because they become self-fulfilling. When consumers expect prices to rise, they buy sooner, which increases demand, which pushes prices higher, which confirms the expectation. The Fed knows this. Paul Volcker knew this in the 1970s when he raised rates to 20% to break the inflation expectations cycle. And the current Fed cannot raise rates aggressively because the economy is too fragile and the debt burden is too large. They are trapped. Too much debt to tighten, too much inflation to ease, and 95% of the population telling them the economy is in crisis while the official numbers say everything is fine. The disconnect between the data and the reality has never been wider, and that disconnect is itself the most dangerous condition an economy can be in. Because it means the people managing the economy are managing it based on measurements that no longer describe the thing they are measuring. And this is where I need to get personal with you for a second. Because I know some of you watching this are in that 95%. I know some of you are making choices right now that you never thought you would have to make. Choosing between the prescription and the grocery bill. Choosing between the car repair and the electric bill. Choosing between the insurance premium and the kids' school supplies. And every time you see a headline that says the economy is growing, or the stock market hit a new high, or unemployment is low, you feel a kind of rage that you can't quite articulate. Because the headline is not describing your life, it is describing someone else's life. And you are being told that your struggle is the exception, not the rule. But the Harris poll just confirmed that 95% of Americans are experiencing what you are experiencing. You are not the exception. You are the rule. The economy that is growing is not growing for you. It is growing for the people whose income comes from assets rather than wages, whose wealth is measured in stock portfolios rather than savings accounts, whose cost of living is a rounding error rather than a survival equation. The economy works for them, and the official measurements describe their economy. Your economy, the economy of the 95%, is in crisis, and nobody with the power to fix it is talking about it in those terms, because the terms they use are designed to make the crisis invisible. America is in the worst fiscal position in its history to handle the next downturn, and the next downturn is here. The Committee for a Responsible Federal Budget, which is one of the most respected nonpartisan fiscal policy organizations in Washington, published a report in March titled "Break Glass: A Plan for the Next Economic Shock." And the opening assessment should stop every American in their tracks. They wrote that the United States has far less capacity to address the next shock than it has previously. Before the Great Recession in 2008, the national debt was 35% of GDP, and the deficit was 1.1%. Before the pandemic, debt was 79% of GDP, and the deficit was 4.6%. Today, debt is 100% of GDP. The deficit is running at approximately 6 to 7% of GDP. And interest payments alone now exceed $1 trillion per year. Every previous recession in modern American history was met with massive fiscal response. The government borrowed and spent to cushion the blow, to extend unemployment benefits, to prop up businesses, to send stimulus checks, to fund emergency programs. And that response worked, to varying degrees, because the government had borrowing capacity. The balance sheet was strong enough to absorb the emergency spending. It is no longer strong enough. The CRFB explicitly warns that a future economic response that adds to the deficit without offsetting measures could itself trigger a fiscal crisis, which means the next time the economy contracts, the government's ability to help is fundamentally constrained by the debt it already owes. Think about what that means for you. In 2008, the government bailed out the banks and extended unemployment benefits and backstopped the financial system. In 2020, the government sent stimulus checks and expanded unemployment and funded PPP loans and distributed vaccines. What happens in 2027 or 2028, when the economy contracts and the government is already paying $1.7 trillion a year in interest, and the debt is 110% of GDP, and the bond market is demanding higher yields because 3 rating agencies have already downgraded the country? What is the response? The CRFB report was essentially warning Congress to think about this question before the crisis arrives. But Congress has not thought about it. Congress is not planning for it. And the crisis may already be here. And I want to make sure you understand how unprecedented this fiscal position is, because the CRFB report was written in the dry, measured language of policy analysis, and the urgency gets lost in the academic tone. So let me say it plainly. Before the Great Recession, the government's debt was 35% of GDP. It had room. It could borrow $4.5 trillion to stabilize the banking system, extend unemployment benefits, fund stimulus, and backstop the housing market. And it did. And the economy recovered, slowly, painfully, but it recovered. Before COVID, the government's debt was 79% of GDP. It had less room, but it still had enough to borrow $5 trillion for stimulus checks, PPP loans, enhanced unemployment, and vaccine distribution. It was more expensive. It added more to the debt, but the economy recovered. Today, debt is 100% of GDP. The room is gone. The CRFB explicitly states that in the past, responses to economic downturns left us in a worse fiscal position, and that policymakers have tended to simply continue borrowing at elevated levels rather than paying down the crisis-era debt after the crisis subsides. We never cleaned up after the last crisis, or the crisis before that. We just added the new debt on top of the old debt and kept going. And now the accumulated total is so large that the interest alone exceeds the defense budget. And the next crisis will add more. Except this time, the additional borrowing may itself trigger the crisis. The CRFB warns that a fiscal crisis caused by Treasury market turmoil, panic over high debt levels, a decline in the dollar, or underlying structural risks is among the specific scenarios they are planning for. The government's own advisors are gaming out scenarios where the government's debt causes the crisis that the government is supposed to respond to. Think about what that means. The firefighter's equipment catches fire. The safety net has a hole in it, and the hole was caused by the weight of the net itself. That is where we are. And that is why the CRFB called the report break glass. The federal government just shed 348,000 jobs in 18 months, and nobody is counting the downstream effects. Forbes documented that federal government employment has fallen by 348,000 positions since October 2024, an 11.5% reduction. That is the most aggressive reduction in the federal workforce in modern American history. And the information sector, which includes technology and media, has shed 342,000 jobs, an 11% decline from its 2022 peak. And these are not entry-level positions being eliminated. These are middle-class professional jobs with benefits, retirement plans, and health insurance. The kind of jobs that support families, fund mortgages, and anchor communities. And when those jobs disappear, the downstream effects are enormous. Every federal worker who loses their job stops spending at the local restaurant, the grocery store, the dry cleaner, the auto repair shop. Their children may leave the school district. Their spouse may lose a second income stream. The local tax base shrinks. And the communities that were built around government employment, particularly in the Washington, D.C. metro area, in military towns, in communities with federal facilities, contract. And Brookings documented that the Department of Education staff has been cut so significantly that managing the student loan transition under the One Big Beautiful Bill Act will be a challenge. The same law that overhauled the student loan system simultaneously gutted the workforce responsible for implementing the overhaul. So borrowers who are supposed to navigate a new repayment system will be dealing with an agency that has lost a significant percentage of the people who were supposed to help them navigate it. And it's not just the direct job losses. Stanford documented that the labor market has settled into a low-hire, low-fire equilibrium, where average monthly employment growth has been just 17,000 since April. That is a level that historically would signal a labor market in crisis, but unemployment hasn't spiked because the labor supply has also shrunk due to dramatically reduced immigration. So the jobs aren't being created, but the people aren't arriving either, which makes the unemployment rate look stable while the underlying dynamics are deteriorating. It's like saying a bathtub isn't overflowing because you turned off the faucet and pulled the drain plug at the same time. The water level looks fine, but the system that was supposed to fill and hold water is broken. And I want to give you a specific example of what the federal workforce reduction looks like at the community level, because the aggregate numbers hide the human stories. A friend of mine lives in a suburb outside Washington, D.C., that was built almost entirely around federal employment. Her neighborhood has 120 houses. In January of this year, 4 of those houses went on the market simultaneously. All 4 sellers were federal employees, whose positions were eliminated. By March, there were 9 houses for sale on a street of 120. By May, there were 14. The home values on that street have dropped approximately 8% in 6 months because the supply of houses for sale overwhelmed the demand from buyers who, in many cases, were also federal employees facing the same uncertainty. The local restaurant that depended on the lunch crowd from the federal office complex saw its revenue decline by a third. The daycare center that served those families lost 40% of its enrollment. The local tax base that funded the schools began to contract. And the ripple effect will continue for years because the people who left were spending money in that community every single day. And their departure does not just remove their spending, it removes their property tax revenue. It removes their volunteer hours. It removes their participation in the PTA and the soccer league and the neighborhood association. The federal workforce reduction is not a line item on a budget spreadsheet. It is the dismantling of communities that were built around the assumption that the jobs would continue. Credit card delinquencies at smaller banks have hit 6.43%, and that's where the real stress lives. When the major banks report credit card delinquency rates, the numbers look concerning but manageable. 2 to 3%. That's the headline number that gets reported. But Forbes revealed the number that nobody is talking about. At banks outside the top 100 by asset size, where lower-income borrowers are concentrated, the credit card delinquency rate stands at 6.43%. That is where the stress actually lives. Let me explain why this matters. The major banks, J.P. Morgan, Bank of America, Wells Fargo, Citi, serve a disproportionately wealthy clientele. Their customers tend to have higher incomes, higher credit scores, and more financial cushion. When those banks report low delinquency rates, they are reporting the financial health of the top of the economic pyramid. The smaller banks, the regional banks, the community banks, serve the Americans who live paycheck to paycheck. The Americans whose savings are depleted. The Americans who are financing groceries on BNPL. And at those banks, the delinquency rate is more than double the rate at the major banks. This is the two-economy phenomenon that I keep talking about. There are two Americas. The top 10%, who own 89% of stocks, whose assets have appreciated, whose incomes have outpaced inflation, who have financial advisors and diversified portfolios and multiple income streams. And then there is everyone else, the bottom 90%, the people whose wages have been flat in real terms for 20 years, whose savings have been wiped out by 3 years of inflation, whose credit cards are maxed, whose BNPL balances are growing, whose delinquency rates are running at 6.43% at the banks that actually serve them. And the official economic data, the GDP number, the unemployment rate, the stock market index, measures the average of these two economies. And the average of a feast and a famine is a moderate meal. But nobody is eating the moderate meal. One group is feasting. The other is starving. And the average describes neither group's reality. That is why 95% of Americans say the economy is in crisis, while the official data says everything is fine. The data is averaging two economies that have completely diverged, and the divergence is getting wider every quarter. And let me give you the most concrete illustration of the two-economy problem that I can. Imagine two families. Family A earns $400,000 per year. They own a $1.2 million home with a 3% mortgage they locked in during the pandemic. They have $1.5 million in a diversified portfolio that has doubled since 2020. They max out their 401k. They carry no credit card debt. Their health care is covered by an employer plan with a $500 deductible. Their children attend public school in an affluent suburb, funded by high property tax revenues. The inflation of the past 3 years increased their annual expenses by approximately $15,000, which they absorbed easily from the returns on their investment portfolio. For Family A, the economy is doing great. Their net worth has increased. Their cost of living increase is a rounding error. They are building wealth every month. Now imagine Family B. They earn $65,000 per year. They rent a 2-bedroom apartment that went from $1,400 to $1,850 over the past 3 years. They have $6,000 in a savings account that used to have $14,000 before the inflation hit. They carry $8,400 in credit card debt at 22% interest. They lost their ACA subsidy on January 1st and now pay $1,200 per month for a marketplace plan with a $3,500 deductible. Their car is 11 years old and needs repairs they can't afford. Their grocery bill went from $750 to $1,050 per month. They just started using BNPL to split grocery purchases into 4 payments because the credit card is maxed. The inflation of the past 3 years increased their annual expenses by approximately $9,600, which they could not absorb because their income only increased by $3,200 over the same period. For Family B, the economy is in crisis. They are depleting savings, accumulating debt, falling behind every month, and drowning slowly. Now here is the point. When you average Family A and Family B, the average American household income is $232,500, and the average net worth is somewhere north of $750,000, and the average savings rate is positive, and the economy looks fine. But neither family lives in the average. Family A is thriving. Family B is drowning, and the official statistics describe a world where neither family actually exists. The average is a fiction, and the fiction is being used to justify policies that help Family A and hurt Family B. And that is what 95% of Americans are trying to tell the pollsters when they say the economy is in crisis. They are Family B. And nobody in power is measuring their economy. Commercial real estate is sitting on $6 trillion in debt, and the Federal Reserve just wrote a paper about why you should be worried. The Federal Reserve Board of Governors published a research note in 2026, acknowledging what many of us have been warning about for years. Outstanding mortgage debt in the commercial real estate sector totaled $6 trillion at the end of 2024. $6 trillion. And banks hold half of that debt, with regional and small institutions holding a larger share than their bigger counterparts. Think about what that means in the context of what I just told you about where the real credit stress lives. The smaller banks, the regional banks, the community banks, the same banks where credit card delinquency rates are running at 6.43%. Those same banks are also sitting on the largest concentration of commercial real estate debt. And commercial real estate is in trouble. Office vacancy rates in major cities are running at 20 to 25%. The remote work revolution did not reverse. Companies that downsized their office footprint in 2020 and 2021 are not coming back. And the loans that funded those office buildings, the shopping centers, the hotel developments, the mixed-use projects are maturing, which means they need to be refinanced at interest rates that are double or triple what they were when the original loans were made. And many of these properties are not generating enough income to service the debt at the new rates. The loans are underwater. The properties are worth less than the debt that funded them. And the banks that hold those loans are facing a choice: foreclose on the property and take a loss, or extend the loan and pretend the problem doesn't exist. The industry calls the second option extend and pretend. It's a strategy that delays the reckoning but does not prevent it. And the longer the reckoning is delayed, the larger the eventual losses become. And remember, these are the same banks that serve the communities I was just talking about. The communities where people are financing groceries on BNPL, where delinquency rates are 6.43%, where savings are depleted and credit is maxed. If those banks take significant losses on their commercial real estate portfolios, their ability to lend to their communities contracts. Small business loans become harder to get, auto loans become more expensive, credit lines are reduced, and the communities that are already struggling experience a further tightening that makes every existing problem worse. That is the connection that the Fed's research note was politely pointing at without directly saying it out loud. The commercial real estate crisis and the consumer credit crisis are not separate problems. They live in the same institutions. And those institutions are the regional and community banks that serve the Americans who are already in the most financial distress. And the scale of the problem is larger than most people realize. According to the Fed's research, $6 trillion is the total outstanding CRE mortgage debt. Banks hold half of it, approximately $3 trillion, and within the banking sector, regional and small banks hold the largest share. These are the same banks that are already under pressure from rising credit card delinquencies, from the declining value of their treasury bond portfolios that lost value when rates rose, and from the competitive pressure of deposit flight to higher-yielding money market funds and online banks. The CRE exposure adds a third layer of stress to banks that are already absorbing two layers. And the Office of Financial Research, which is the Treasury Department's early warning system for financial stability risks, has flagged CRE concentrations at regional banks as a systemic concern. Some regional banks have CRE exposure that exceeds 300% of their Tier 1 capital, which means a 33% decline in the value of their CRE portfolio would wipe out their entire capital base. And office vacancy rates in some major markets are approaching 30%. A 33% decline is not a worst-case scenario. It is the base case for the hardest-hit markets. And when a regional bank's capital base is impaired by CRE losses, the FDIC becomes the backstop. And the FDIC Insurance Fund, which covers deposits up to $250,000 per depositor per institution, has been stretched by the bank failures of 2023, including Silicon Valley Bank and Signature Bank. The fund has been rebuilt somewhat, but is not at the level that would be needed to absorb multiple simultaneous regional bank failures. And the $250,000 limit has not been raised since 2010, which means in real inflation-adjusted terms, your federal deposit protection has shrunk by approximately 31%. Every layer of the financial system is thinner than it was the last time it was tested, and the test may be coming sooner than anyone in an official capacity is willing to admit. Recession risk is running at 25%, and the shock absorbers that prevented the last one are gone. U.S. Bank's Weekly Economic Outlook, published 6 days ago, puts the recession probability at 25%, well above the 15% long-term average. And their analysis contains an insight that I think is the most important economic observation of the year. They noted that in 2022, every recession warning light flashed: aggressive tightening, an equity bear market, yield curve inversion, recession-level leading indicators, all the signals aligned. And yet no recession followed. Why? Because consumers had shock absorbers: low fixed mortgage rates from the pandemic refinancing wave, fiscal support from stimulus programs, excess savings accumulated during lockdowns, strong wage growth. The Fed hit the brakes, but households were driving a car with unusually good suspension. The suspension absorbed the shock. Here is the critical question for right now. Where are those shock absorbers today? The excess savings are gone. The personal saving rate is at 2.6%. The stimulus programs expired years ago. Mortgage rates are running at 6 to 7%, not the 3% that millions locked in during 2020 and 2021. And wage growth, while still technically positive in nominal terms, is being consumed by the price increases that tariffs, oil prices, and embedded inflation are generating. The shock absorbers have been used up. They are gone. And the next shock, whether it comes from a debt ceiling crisis in August, from a collapse of the AI investment bubble, from a renewed escalation of the Iran war, from a commercial real estate correction that hits the regional banks, or from the simple accumulation of consumer exhaustion that is already visible in every data set I have shown you today, will hit an economy that has no suspension left, no savings to draw down, no stimulus to deploy, no fiscal capacity to borrow, no monetary space to cut rates without reigniting inflation. Every buffer has been consumed, every cushion has been flattened, and the economy is driving at full speed on bald tires toward a road that is covered in potholes. Dean Baker, co-founder of the Center for Economic and Policy Research, told Newsweek, "I think the main risks of recession are a collapse of the AI bubble and the war. $100 plus oil prices could bring us very close." Mark Zandi, chief economist at Moody's Analytics, said higher oil prices have already lifted gasoline prices, and that with higher diesel and jet fuel prices, inflation for other goods and services will accelerate. The experts are not debating whether the risks are real, they are debating which risk hits first. And I want to explain what a recession without shock absorbers actually looks like, because most Americans under 50 have never experienced one. The 2008 recession was cushioned by the government's ability to borrow $4.5 trillion and deploy it through TARP, stimulus checks, unemployment extensions, and emergency lending facilities. The 2020 recession was cushioned by $5 trillion in emergency spending, stimulus payments, PPP loans, and enhanced unemployment benefits. Both times, the government stepped in and absorbed the economic pain by adding debt. And the American consumer, who had been building savings and reducing debt in the years before each crisis, had enough personal cushion to survive until the government response arrived. None of those conditions exist today. The government's balance sheet is maxed, the consumer's balance sheet is maxed, and the Federal Reserve, which cut rates to zero in both 2008 and 2020, is currently at rates that it cannot cut aggressively without reigniting inflation that is already running above target. A recession without shock absorbers means that job losses translate directly into mortgage defaults because there is no savings cushion. It means layoffs translate directly into credit card delinquencies because there is no emergency fund. It means medical emergencies translate directly into bankruptcies because there is no insurance for the 5 million who just lost it. And it means the recession, once it starts, is harder to stop because the government's fiscal capacity to respond has been consumed by the $36 trillion in debt that the previous responses generated. That is the world we are entering. Not a world where the recession might come. A world where the recession, if it comes, will hit harder and last longer than any recession in modern American memory, because every institution and every household that was supposed to provide a buffer has already spent the buffer on the crisis that just happened. The healthcare and safety net cuts just took effect, and the first casualty data is coming this summer. And here is the final piece of the picture that ties everything together. Brookings documented that several of the One Big Beautiful Bill Act's healthcare cuts took effect on January 1, 2026. Enhanced ACA tax credits expired. Policymakers' decision to let them expire, even as they continued $3.9 trillion in other expiring tax cuts, raised premiums for 20 million Americans. The CBO projects that approximately 5 million people will ultimately lose health insurance as a result of the healthcare changes. And more than 2 million people will lose access to SNAP in a typical month due to expanded work requirements. And here is the timing that should alarm you. Brookings noted that the first official data reflecting these changes from the National Health Interview Survey would typically come out this summer. The first SNAP enrollment data reflecting the new provisions should also come out this year, which means we are weeks away from the first official measurement of how many Americans have actually lost coverage and food assistance since these changes took effect. And that data is going to be devastating, because the changes were implemented during a period when the labor market was weakening, when savings were depleting, when consumer spending was being propped up by credit rather than income, and when 95% of the population was already telling pollsters they were in an affordability crisis. The safety net was cut at the exact moment the need for the safety net was increasing, and the first casualty count is about to arrive. And I want to prepare you for what that data is going to show, because I have been tracking the leading indicators all year, and the picture is not going to be pretty. The first wave of ACA subsidy losses hit in January. The enrollment periods for marketplace plans closed in the spring. The people who could not afford the doubled premiums either downgraded to catastrophic plans with deductibles so high that they effectively have no coverage, or they dropped coverage entirely. And the people who dropped coverage didn't suddenly stop getting sick. They stopped going to the doctor. They stopped filling prescriptions. They stopped getting screenings. and the conditions that were being managed with consistent care are now unmanaged. The diabetes that was controlled with metformin is now uncontrolled. The hypertension that was managed with lisinopril is now producing kidney damage. The depression that was treated with therapy and medication is now untreated. And within 6 to 12 months, those unmanaged conditions will produce emergency room visits that cost 10 to 50 times what the prevention would have cost. And those ER visits will be absorbed by hospitals that are required by law to treat anyone regardless of ability to pay, which means the costs get shifted to the insured population through higher premiums. And the higher premiums push more people to drop coverage. And the spiral deepens. The healthcare safety net was not cut in isolation. It was cut during an affordability crisis, during an inflation spike, during a labor market slowdown, during a period when consumer savings were at their lowest level since the pandemic. Every condition that would have made the cuts manageable is absent, and every condition that makes the cuts devastating is present. And Brookings made one more observation that I need you to hear because it connects every single point I have made in this video. They warned that a weakening labor market would raise the stakes of the OBBA's healthcare and safety net cuts because it would increase the need for Medicaid, ACA tax credits, and SNAP, make it even harder for vulnerable people to meet 80-hour-per-month work requirements, and reduce state revenues as states decide how to respond to federal funding cuts. In other words, the cuts were designed for a strong economy. The economy is no longer strong. And the gap between what the cuts assumed and what the economy is delivering is going to be filled by human suffering. By people who lose coverage and cannot afford treatment. By families who lose food assistance and go hungry. By workers who cannot document 80 hours of employment in a month because the economy isn't giving them 80 hours of employment. And by communities whose tax base shrinks as the federal workforce contracts and the consumer spending that those workers supported evaporates. Fellow Americans, this is not a warning about something that might happen someday. This is a description of what is happening right now. The savings are gone. The credit is maxed. The prices are still rising. The tariff increases are planned. The safety net was cut. The debt is at 100% of GDP. The recession risk is elevated. The shock absorbers are depleted. And the first official data measuring the human cost of all of this is arriving in the next few weeks. I don't say this to make you afraid. I say it because you deserve to know the truth about the economy you are living inside. The truth that the official data is designed to obscure. The truth that 95% of Americans already feel in their bones, even if nobody on television is confirming it for them. It's about to get very bad. And the people who are prepared, who have reduced their debt, built their savings, strengthened their communities, diversified their income, and paid attention to the data rather than the talking points, those are the people who will weather what is coming. Be one of those people. Start today. Because the data that just came out is not a false alarm. It is the alarm. And it is ringing right now. And the fact that 95% of Americans can hear it while the official data claims there is no sound is the most dangerous economic condition this country has been in since 2008. Because in 2008, the data and the reality converged. The numbers confirmed what people were feeling. The crisis was named. The response was mobilized. In 2026, the data and the reality have diverged. The numbers say one thing, the people say another. And the gap between those two stories is where the real damage is happening. In the gap, in the silence between the headline and the grocery receipt, in the distance between the GDP number and the savings rate, in the space between the unemployment figure and the BNPL balance. That gap is the crisis, and nobody is measuring it. But you can feel it. And 95% of your neighbors can feel it. And now you know you're not imagining it.